Welcome back to Golden Rule Radio. I am back from a trip last week, and thank you to Rob and Tori for holding it down. And Rob, you did such a great job last week. I had to bring you back and pick up where you and Tori left off a little bit. Welcome.
Well, thanks. Tori and I were talking about the possibility of gold getting down into the 1680s, and it's looking more and more likely.
Yeah, Monday, Tuesday have been a good coin flip for you guys.
Yeah.
So I think we're sitting down here in the mid 1700s, 1760s, I believe, at the moment.
Oh, no, we're at 1720.
Oh, then I should have not gone out of town last week and then had a 4th of July break.
Let me make a correction. We are at 1737.
1737.
Yeah.
So we're on our way. That 1680 has been our baseline for quite a while now. It's been a massive trading range, 1680 all the way up to 2100 and a couple trips back and forth. So what do we think? Here's our segue for the day. What do we think it's going to take for gold to actually move, or could we be looking at an extended pause in the price move of gold? Maybe some significant up and down trading in a trading range.
I think that's what we are going to see. I think we're going to see gold retest our long-term base at 1680, and I think we'll bounce around between 1680 and probably 1760 is my guess. I think we're going to be here for a while, at least through the summer. As you and I were looking over the charts with equities, the Fed's balance sheet, the interest rates, the Fed is sticking to their agenda, fighting inflation and raising interest rates and flattening the balance sheet. And for the foreseeable future, that's where we're going.
Right, and I think that leads us into the big question I know I've been getting from a lot of my clients and seems to be a recurring theme when you turn on the news or watch TV commercials. What happens in a deflationary recession? What happens when we have a tightening of money supply? Or maybe not tightening, but just a stagnation of money supply. We've been living in this era where the printing press has been the hammer that hammers every nail. Mm-hmm. And toe and whatever else you can hit with it. What happens if the Fed, like you said, sticks with it? Do they have the gumption to do so? And if they do, what does that look like to the equities market, the currencies, foreign relationships between us and other currencies, and specifically at this table in this building, gold?
Well, I think that gold is going to be pretty boring for the foreseeable future for the next few weeks. I think the equities market is beginning a downturn. If they are not going to prime the pump with raising the money supply and adding to the balance sheet like we've been discussing, the equities market's got a ways to go down further. And the question becomes, how political will the Fed become? It's possible that the Fed has already conceded a Republican victory in the fall. And so as far as they may be concerned, if they are going to be political, they could keep this up for the foreseeable future until the pain becomes too great, because I do think commodity prices are dropping. I know lumber is beginning to fall. I don't know about aggregate. Oil is down, but we're still paying a lot at the pump. So my guess is that we are going to see, like what we've seen today, is bond rates are starting to go back up. You pointed out earlier that the inverted yield curve has rightened itself, and so now the 30-year yield is higher than the 10-year yield, and they're both rising, and it looks like a big move to cash. The dollar is at 107 today. Just 3 weeks ago, we were at 103. That's a pretty significant jump in the dollar. And
right.
While we can argue that the dollar is overbought and in want of a correction, I don't see that happening in the near future. I see the dollar continuing to strengthen.
Or if it does, to what significance?
Right.
To what degree? Are we looking at a couple point decline in the dollar and continued growth and strength in the dollar? And in a time of uncertainty, in a time where, say, the VIX is increasing, even if marginally, and increased in certainty, what do people do? They get solvent.
They do, and they go to cash. But then even when you go to cash with a strong dollar, you're still losing. If inflation is, say, 8%, and I think that's a modest figure, you're still not being paid to move to cash. And so I do think there is a lot of thought being given to what do we do now. I think gold continues to be a great value for people who are looking long term. Where are we headed long term? I think we know the answer to that.
Well, I wanted to take a minute and look back at some of the historical context. So that was something I was looking at getting ready for today's show. And I find a couple things worth pointing out. As Greenspan was raising interest rates to combat the rising housing prices that had occurred earlier in the 2000s, it wasn't really until we were already pretty deep into the decline in the equities market that they finally tanked interest rates.
Right.
So it was kind of a last-ditch effort to stave off the bleeding, and we still saw a 50% plus decrease in a number of the markets.
And you also saw a big drop in housing values. I mean, right now people are taking comfort in the fact that their 401k is now a 301k, but the value of their homes continues to give them comfort. Well, I'm sitting in $1 million house. Well, maybe it is today, and they bought it for $350,000. So the value of their house may have doubled or tripled since they bought it. So they do take comfort in that, and that's what people look for. Well, where am I doing well? Where am I not doing well, kind of thing. But if you have a drop in real estate prices, a drop in bond values as rates continue to rise, and that's what happens. So you've got bonds falling, stocks falling, and then suddenly the housing market slows down and begins to fall. That's when the pain index really gets ratcheted up.
And I tend to highlight, when I'm looking at history, the cyclical nature and the undervalued and overvalued approaching investor. Now, what I think the Fed Reserve and the Fed Bank and Geithner and Greenspan and now Jay Powell, what I think they're looking at is they're saying, okay, Greenspan waited too long because we saw a significant decrease in the interest rates near the tail end of the market decline, and we saw the Fed balance sheet jump from about $900 billion to about 2.2, 2.4 trillion. So 200% increase in the Fed balance sheet and a massive decrease in the interest rates. And lo and behold, we saved the market. So guess what? The next time we have anything that sniffs like a crisis, well, what happened in 2020? They immediately did the same thing day one.
Huge Fed pivot.
Yes, exactly. Similar plan, but a completely different time. It's this worked. We have proof it worked. I would disagree. I think that's how market cycles work, but I don't work at the Fed, so they don't care what I have to say. So their plan worked, and it's the only thing that saved us. So let's do it the second we see a problem next time. Well, what ends up happening, an equities market, which I would argue was starting to show signs of being oversold, because I tend to remember that a couple of years ago in around 2019, we were in here talking about some of the potential debt crisis. And remember the discussion about the overnight lending rates that occurred before anybody had ever heard the word COVID? That was 6 months before COVID happened. We were starting to see topping events in the market at that time. So what did the Fed do? And this is what I thought was interesting, and this is why I brought it up to you earlier. We actually had a pretty healthy market between about 2014 and 2018. You had natural growth in the equities market. The Fed balance sheet had tapered off. The Fed balance sheet stopped buying. Now, they didn't start selling till later, but they stopped buying around 2013, 2014. Interest rates were still flat, but they started going up around the beginning of 2015, and the equities market kept climbing. So to me, that smells pretty healthy. But you pointed out something in that same time period that I somehow completely overlooked because it's one of my favorite data points, and that's the money supply. So what happened to the money supply during this period where you have flat Fed balance sheet, increasing interest rates, and still a rising equities market? It went up about 35%. The money supply did. And the euro dropped 24% during the same time period. Now, that wasn't the Fed buying. So where was that 35% increase in the money supply going?
Right into equities.
Exactly, right into equities, and I would argue on the corporate and banking side of equities.
They were sitting on so much cash.
And the second they get a whiff of a major problem, they didn't wait 6 months, a year, 18 months like they did in 2008. As soon as March of 2020 rolls around, what do? They floor the interest rates and step on the Fed purchasing gas.
Mm-hmm.
Well, here we're now again at the top of an equities market move. Fed buying is starting to taper back down again. Interest rates are starting to go up again. They're starting to try to do some things to combat the inflation that they've put into the system because it took a couple years, but prices are starting to rise. Gold is up 60-70% in the last 5 years. And I know it's down from the high a year or two ago, but let's be realistic. Since 2015, gold's up like $700. There's some concerns out there. Are they going to stick to their guns? And my question is, if they can't buy it back themselves through the Fed balance sheet, if they're going to continue raising interest rates, if they're going to fight inflation on top of this, either adding that third piece that wasn't part of the puzzle 5 years ago and 10 years ago. So the corporates can't buy it with the free money. The Fed ain't buying it because they've agreed to taper back their buying. And you and I can't buy it because interest rates are going up and our cost of living is going up. Where's the equity market going?
Not looking good.
No. So if we see a deflationary recession caused by some of the overbuying that took place over the last 10 years, finally coming back to get us, and the equities market takes a significant decline and real estate probably gets hit even harder, is there anything safer than gold? Getting back to where your initial argument was, is there anything safer than gold sitting at a reasonable price for an extended period of time?
I think you already know the answer to that.
I mean, I want gold to go up too. I like when the US dollar number gets bigger, but who cares? Because what you really care about is what you can turn that precious metals back into. So if gold sits stagnant and the stock market gets cut in half, you just picked up twice as many shares of your favorite company when this is all said and done.
And the Dow Gold Ratio is something that we really focused on 23, 24 years ago.
Mm-hmm.
You know, how many shares of the Dow can an ounce of gold buy? And right now I'm going to say we're probably in the mid-teens. I need to take a look at that. But we get to a place where it only takes 4 or 5 or 6 ounces of gold to buy the Dow Jones Industrial Average. That's a compelling time to begin to reallocate from gold back to equities. And I think we'd be looking at better dividend yields. We'd be looking at a healthier price to earnings ratio, better than it is now. And then again, constantly rebalancing in our future, because that's what we're talking about. We're trying to balance and be in a position where we can take advantage of opportunities, be it equities, etc.
Right. So there's an argument to be made, I think, right now, that taking some time to look at the whole forest and not just the trees, and looking at how some of these markets interplay with each other. And, you know, like you brought up with the dollar a minute ago, 103 to 107, that is dry powder. People don't go into cash to sit into cash. People go into cash because they're waiting for or believe another opportunity is right around the corner, or they're fearful and they don't know what else to do.
Right, but if you're sitting in cash with an 8% inflation rate, you're already guaranteed to have that much loss at the end of the year.
Right.
So when you talk about deflation, you're not talking about deflation as it affects you and I, you know, at the pump and at the grocery store. You're talking about deflation in terms of equities and real estate and commodity prices.
And you're not going to see that translate to the pump on a day-to-day basis either. We're seeing the effects of inflation 18, 24 months ago today.
Right.
So it's going to be another 18 or 24 months, assuming they hold the course, before you start seeing deflation or at least decreased inflation start translating back out to your and my day-to-day cost of living. We look at these things not just because we find them interesting. I mean, obviously, seeing the way people interact with markets has always been a fascination of mine. But we look at these things, for lack of wanting to use a one-penny word, opportunity. But it's not just the opportunity of how many US dollars can I be worth. For me, it's the opportunity of how many ounces of gold can I translate into shares of the Dow Jones Industrial Average?
Or a 3-bedroom, 2-bath house.
Exactly. Or a second 3-bedroom, 2-bath house that you can now rent out as income.
Right.
And that's what we're looking at it for. I don't want to pay 40 ounces of gold to buy the Dow, but I will pay 5.
Yeah.
So that's why we like to look at these things and how they translate over time throughout market cycles and how the Fed's reacting and what's going on in China, what's going on in Europe, because it's a good reminder that these markets do take time. It takes time to turn the ship. And you do have periods where people move from market to market to market to market as money translates its way through the economy from selling equities for a gain into a cash position and then looking for the next opportunity, whether it's coming back into equities. Or maybe it's 2009 and the market's still falling and interest rates are terrible and you go into gold, which does end up going from 650 to 2000 in the course of a year. We always encourage people to look at the markets as a whole, position themselves accordingly, and I think you also brought up a key, and that's the idea of be willing to be maneuverable, be willing to move money between these different markets when it makes sense to do so. And when those ratios, not just gold and silver ratio, not just platinum palladium ratio, but Dow to gold ratio, equities to gold ratio, real estate, acres to gold ratio, square foot to gold ratio, I think is a better way to put it. I think that's something you guys did actually track back in the 80s and 90s too,
Way
the
back.
square foot to gold ratio.
Yeah.
That's something you can keep track of. So we know that gold is going down right now. We're not trying to avoid that conversation, but what we are saying is we've been talking about cyclical nature of the markets for years.
Yeah. And Kevin and I were talking again today. I bought a bunch of gold in the 1840s. Should I have waited? Yeah, I could have, but I didn't want it to occupy my time. I just said, okay, it's distracting me from things that are more important to me besides just my money. So I just went ahead and did it and said, heck, I don't care. 5 years from now, it's not going to matter.
Right, because it's about translatable purchasing power, not just the number of zeros. And with that being said, gold's still up like $750, $800 in 6 years. So that's pretty good to me.
I like it.
So Rob, thanks again. That's going to do it this week for us on Golden Rule Radio. If you liked what you heard, hit the subscribe button, ring the bell. You can find us on Twitter at ICA Gold or Facebook at McIlvaney Financial. And hey, if you'd like to talk about your personal portfolio with Rob, myself, or anybody else here at McIlvaney ICA, give us a buzz. We can be reached at 800-525-9556. Thanks for listening and have a great week.